Hello everyone, Corey here with the Cyclical Investors Club YouTube channel, and this week we're talking about highly cyclical businesses on the channel, and this specific video is going to be my sell idea for the week. So this is going to be a high quality cyclical that has probably just gotten a little too expensive, and if I owned it I would start thinking about taking profits, okay? And the name is Pentair, and in this video we're going to go a little in depth. I'm going to kind of show you what I'm thinking about, and we'll also review some of my sell ideas from the previous few weeks. All right, with that, after this disclaimer, we'll get right into the video. Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club Premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. Okay, before we get into Pentair and why I think that if I own the stock, I would be considering taking profits right now. I don't own this one, but before I get into that, I want to look at some of the other suggested sell suggestions from this month. So we're 4 weeks into the new year and the YouTube channel, and so I've had 3 other picks. So I like to always check in on the performance and see how they're going, even though this is pretty early on in the process. We see that, and just to review, so when I write sell suggestion articles, these are for companies I consider high quality, but basically just the price has gotten too high, okay? So there's nothing really wrong with the business. They might even have fantastic businesses, but the prices have gotten high enough where it makes sense to think about taking profits. So we had Nike, Intuitive Surgical, and Estee Lauder. Intuitive Surgical reported earnings, and as you can see, they had a big decline this week. So almost over 9% decline, because the market was just, their expectations were too high for the stock. And that's what happens with these stocks when the prices get too high. And so the total performance, the average performance of all 3 is minus 3.5% about, while the market was up a 1.5% about. So about 500 basis points underperformance for these, again, high quality businesses, but just too expensive. And I'm going to put Pentair in that category as well this week. So I had a theme this week of highly cyclical stocks, and I had a difficult time finding really high quality cyclical stocks that were sells. There were a couple of them that I considered, like Caterpillar and Deere, but I thought that Pentair was a little bit more of a better bet right now in terms of taking profits. But on the flip side, they aren't quite a highly cyclical stock. They're really close. So if we look at their earnings declines, I usually look at about, if I see minus 50% EPS declines or more, I consider that a highly cyclical. These guys are pretty, I'd call them moderately to highly cyclical. If we look back at the Great Recession, they declined over 33%. And then this section here, they had a little bump one year, but I mean, if you combine these together, we're getting close to 50% decline from peak to trough. So that's right around where I would call stock highly cyclical with the earnings. So these are, let's say, moderately to highly cyclical, but it's kind of right on the border. Nevertheless, I thought that they would be a pretty good example for what I'm talking about here. So the dark green area is earnings, EPS, and the black line is the price. So we can see a big disconnect between the price and the actual earnings. Let me shorten this graph up a little bit here, and we'll see. So this dotted line is what analysts expect earnings to do, and they definitely expect earnings to grow a little bit, like let's say an average of 10% for the next couple of years. Okay, that's good, but it's not the same type of really cyclical recovery that we would see like coming out of the Great Recession. We saw 30% and 20% They took a year off because 2012 was kind of a weak year economically, and then bam, another 30% year. Okay, they are not expected to do that during this recovery. All right, but the stock price is treating it like it is. So it went from, you know, these are monthly numbers, but $30 a share, we'll say, up to almost 60, right? So almost doubled from the bottom. But really, we're not looking at like a giant gain coming. At least analysts don't expect it. Now these could always surprise and be higher, and then analysts would be wrong and the stock market would be right. That's possible. But with 100% gain and only 10% earnings growth expected, this is something I would definitely, just in terms of the magnitude too. We're also talking new all-time highs. Okay, so the all-time high was back here many years ago, 2014 it looks like. So we have a new all-time high. The momentum is fantastic. So for a stock like this, I would consider putting like a trailing stop on it at 10 or 15% or whatever. And then if it starts coming down, you'll give up a little bit of the gains, but you'll sell up here. And who knows? This is a stock that could retrace, probably, even if it retraced back to the highs here. I mean, that's a 30% decline from where we're at here almost. So if you can avoid some of that, I think it's worth, you know, just considering taking profits and using that trailing stop. If the momentum keeps carrying, you could maybe lock in some more upside on the way up. So that's how I would do this if I owned it. I ended up not buying this one. I bet it was pretty close to my buy price, and I want to say this is one that just missed it. Let's take a look at it from a cyclical perspective. So again, this is a high quality stock, a high quality business. If we quickly go back to the fast graph, if you just look at the big picture, while earnings are lumpy along the way, the general trend is definitely going up, you know, and they had kind of a big little upcycle there, you know, probably have to do with, I'm guessing, fracking is my guess, some other type of industrial stuff. Then we had kind of an industrial recession here that didn't really match like the wider recession around 2015, 2016. Okay, so there's kind of a bump here, but that comes back down. But the general trend is definitely, you know, a solid earning business that's growing earnings over time. All right, so nothing wrong with the business. Credit rating's okay. Debt doesn't look crazy at all. So again, nothing wrong there. But the drawdown potential is pretty big going forward. So if I was looking to invest in this, just glancing at this, all else being equal, these usually understate a little bit because they're monthly. So these are almost all probably 50% drawdowns, let's call them. Okay. That's probably where I would look to have bought the stock during a recession. And back in March, I thought we were having potentially a normal 50% decline in the S&P 500. So I probably was aiming for a 50% drawdown, and they took like a 40% or something like that instead. So that's probably why I missed it. But we can see the stock price has fully recovered to new highs. They're making new all-time highs. That's great for investors that bought down there or bought beforehand. Everybody's basically positive on the stock. But those are the times when you want to think about taking profits. The potential upside of getting another 100% from here is going to be pretty low. If you look at the space between when it makes new highs, they had a good run here in the late 90s, it looks like. But usually it doesn't take long before there's another big drawdown, you know? I mean, let's say, I mean, look, it's less than a year. It's at all-time highs here. Again, maybe you give it 2 years here, okay? Give it a couple years here, coming out of the bottom there. And then there's another drawdown. And these are deep enough drawdowns where it definitely pays to take profits and then try to buy back again when you get another one. Because you're getting one every, let's just look. I mean, getting a major drawdown over 30% is roughly what I considered an investable drawdown where it's worth selling, you know. So that's 88. There's 3 years between then. And we had a big, huge run in the 90s, all right? But since then, every 3 years, almost every 3 years. I mean, you're almost not going to be, except for during this big recovery period here. So you're probably not going to get, you're probably going to get a chance to buy the stock cheaper. I guess that's all I'm saying. And I would consider taking profits. So we'll add this one to the sell list. I specifically wanted one that was a little bit more cyclical. A lot of those stocks are trading down still. So it was kind of hard for me to find one in that category, but I did want to at least give, you know, a suggestion of what they kind of look like. And they do kind of look like this. And you can see this kind of pattern playing out on this last cyclical top here. So, you know, if you would have taken profits here somewhere, you would be in very good shape. You would have missed out on all this sideways and down move, and you could have been invested in something else that was going up. All right, I'll add this one to the spreadsheet for next week, and we'll see how it performs over the medium and the longer term. If you like this, click subscribe, drop a comment if you have a comment, and I'll try to answer them. And thanks for following the Cyclical Investors Club YouTube channel.